Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Stuart Draper, the former CEO and founder of Stukent. Stukent is an educational technology platform serving colleges and universities, primarily here in the States, with an innovative approach to content and a simulation platform that allows students to try and practice to get real world experience. Stukent grew steadily and became quite a sizable company in the small town of Idaho Falls, Idaho. In 2021, Stuart sold majority of his company to private equity investors, stayed on for a couple more years after that experience, and is now on the board and watching Stukent grow. Stuart shares his lessons learned from growing the company and how he survived and thrived amongst the giants and his own experiences selling a company to private equity investors. It's a great episode. Hey, Stu, welcome to the Practical Founders Podcast.
Thanks, Greg. So good to be with you. Thanks for having me.
Awesome. You're in Idaho Falls, Idaho, which isn't too far from where I spend a lot of time in Park City, Utah. I'm a big skier and spend a lot of all parts of the year there. You're just north of there. That sounds like a little small mountain town. Is that really what it is?
Idaho Falls serves about 250,000 people from all the small towns in eastern Idaho.
Okay.
And
Greater Idaho Falls.
Yeah, greater Idaho Falls. So we have, all the main key amenities. We sell a lot of potatoes, but we also have the internet in 2024, it turns out. So we're okay.
Well, you have built and sold a pretty sizable and cool company. I imagine it's pretty cool in Idaho Falls, and you're probably a famous guy around town for
I
building
don't know
that
about
company and
famous.
selling it.
I don't know about
Mm.
famous, but it's been fun, to have the governor send a letter that says, "Hey, congratulations on being the fastest growing company in the state of Idaho, or one of the fastest growing companies in the state of
Yeah.
Idaho," depending on each year and how we rank in the 85,000 list. But yeah, it's been a fun time. I've enjoyed Idaho, Greg, and starting a business in Idaho because recruiting is a little easier here. In that it's
Yeah.
we're in in blue ocean, right?
Big
And
fish, small pond.
yeah, blue pond, not red ocean or red sea. It's just there's a lot
Yeah.
more opportunities available in bigger cities, but there's also a lot of companies fighting for the people looking at those opportunities. And so we've enjoyed being in Idaho Falls.
That's awesome. And are you from Idaho and this is your home state?
Grew up in Vancouver or Ridgefield, Washington, just north of
Oh, right.
Oregon.
Okay.
My grandparents lived here in Idaho, and I'm number 6 of 8 kids that all
Yeah.
attended either Ricks College or now BYU Idaho in Rexburg, Idaho. And then
Yeah.
my career and job opportunities and startups all just kind of kept me here in Idaho.
Well, it's one of the amazing practical founder stories. You're a success story here. We'll talk about your journey with Stukent, but you said something very wise there. It's not a red ocean, it's a blue pond, which is a magic trick of practical founders to go where the big guys don't go. And the contradiction of, you can't build a company in some rural place that doesn't have a lot of tech and doesn't have a ton of employees, but you found a way to do it. Stu, let's talk about Stukent so people understand what that is. And we'll talk about the exit and then go back to your journey.
Yeah, Stukent's on a mission to help educators, help students, help the world, going into its 11th year of life. And I have loved getting to watch us support now. We've just been celebrating having supported over 1 million students, Greg, and that's been really
Awesome.
fun.
Congratulations.
Yeah, thank you. And
And what's the population of Idaho these days?
Idaho is shy of 2 million people that live in
Okay.
the state of
So
Idaho.
you're having a big impact from a state in the United States, the Northwest there. What is Stukent?
Stukent is an ed tech company. We provide simternships, a coin we termed and have the trademark for. Simternships are simulated internships
Hmm.
that business students can go through in college while they're reading our textbooks. So they get to immediately put into practice the things they're learning in their textbooks.
And so that's kind of your magic trick. It wasn't traditional textbooks or traditional e-learning, we would say now. You had a platform that allowed people to try things and play things and simulate a real world environment. It was very digital marketing focused, which is changed every year and was a very, let's say, tactic or practice oriented world. Not a lot of theory in there. Are you still focused on digital marketing education, or have you expanded out to all types of education?
I always told the team, anyone we hired knew that we are what Under Armour was to Nike and Adidas. That's what Stukent is to Pearson and McGraw Hill. And the reason I shared that was because I would then go on to share the story of Under Armour and how they first sold just a spandex T-shirt for under your football pads, and they
Hmm.
really won that category really well. So for us, our first category was digital marketing, and we became by far and away the leader of that category, owned it, and curated raving fans, and it made it easy to go back to those fans and get their colleagues and peers to then adopt the other additional products we've added to the mix. Stukent now sells to over 40 different subjects in higher
Mm.
education and high school.
Right. So it's a story of laser focus and great timing and fanatical energy to start, but it's expanded out and grown into a leader of the innovative education tools, selling to universities and high schools and community
Mm-hmm.
colleges here in the States and maybe around the world.
And that's right. Yeah, I think over 8,000 institutions globally now. It's been fun to see how top tier business schools, the Harvards of each country, they teach their
Yeah.
business school in English. And so they have adopted and used our platform.
Well, that's amazing. And you're the founder of this company, the head entrepreneur and the chief evangelist for Stuken, but it's not your day job anymore. You sold the majority of the company back in 2021, so they're just over a few years ago.
Mm-hmm.
And you, I guess, are still on the board and still own a piece of it and are still involved. You're still mentioned on the website as the founder, but it's not your day job. What can you tell us about selling Stukent to Tritium Partners, a private equity investor?
Yeah, after 10 years of basically from the age of 30 to the age of 40, it was my eat, live, breathe, sleep, bleed Stuket
Yeah,
kind of
yeah,
lifestyle. And I loved it. And it was awesome. And it's so awesome now to be on the board. And I just went to lunch with the CEO on Monday, Jim Holm. He's
yeah.
been at Examity as the CEO and at Certport, both in the education space. He's grown and scaled large education businesses, and it's fun to watch him take his turn at Stukent. When I sold in 2021, I wanted to make sure that if I did sell the majority ownership of the business, I was selling it to a group I would be proud to work with and that had proven themselves over the long haul. They're the guys that Tritium Partners are the folks under the name Austin Ventures that bought
Ah, right,
HomeAway and VRBO and
right.
sold to Expedia for what was it, $4 billion or something
Yeah,
like that.
billions. Yeah.
So, yeah,
So, what can you say about the size of the company, revenues, and employees at the time you sold it?
yeah. So Stukent at the time was coming up on 8 figures in revenue, right about at 8 figures in revenue,
Hmm.
and they came. That was kind of the wheelhouse of Tritium. You'll find that with
Yeah,
potential acquirers of your business, they all have different check sizes they like to write, and
they're ICP.
yeah, exactly. And so for us, we were the right fit for them. They were the right fit for us. We ran a process, hired Vista Point Advisors out of the Silicon Valley to be our investment bank. They did a phenomenal job representing us, ran a process, over 70 interested buyers, broke it down to 12, did management presentations. There's like a bidding process.
Right.
Greg, you learned so much from that experience. If you want to
Yeah.
talk more about that, I'm happy to.
Yeah. And that's something that founders might do once in their lifetimes, that whole process. And the other side of the table is doing it every week, multiple times, right? So it's a different game.
That's
So
why
that
it's
was,
so important to
yeah.
have representation, right? It's so important
Oh,
to have
yeah.
representation.
So that was, let's say, heading over 10 million in revenues. And was that like 100 employees or something like that and profitable?
Yeah, over 100, 110, 120 employees, somewhere in there. Very profitable in that since 2016, we hadn't taken on any investor money. So for 5 years, we had just been going off of our own bootstrapped, reinvest retained earnings kind of approach versus
Right.
taking more investor money and trying to go to the moon overnight.
Yes. And what was your version of investor? Was that wasn't it was pretty practical investment to get up and running and help fund your fast moving growth.
Yeah, I am really proud of the type of investment that people made and the size of return they got.
Yes.
Great returns for folks. If you put in 25 grand, your payday was just shy of $1 million. If you put in 25 grand,
Was this like friends and family and
friends
cousins
and
and
family, yeah. A
oh my
mentor of
gosh.
mine, I worked for a funded startup out of college. They ran out of funding and that business
That
went
happens.
under. But one of the men that kind of came in as a VC on-site entrepreneur, what do you call that guy? That
Entrepreneur in residence kind of thing
entrepreneur in
or
residence. His name was Corey Smith. He'd sold his pharmacies to Walgreens. He
Hmm.
took a liking to me while I was kind of one of the leading sales guys at that startup, and just followed me over the years. And occasionally
Yeah,
I'd go to
very
lunch
nice.
with him. And one day I ran the idea by him to start Stukent, and he sent me a check in the mail for 25 grand after I showed him my business plan, and said, we don't need to worry about valuation. I trust you on that part. What I want you to do is quit, get started, and I'll start helping make introductions because you're onto something big.
Right. Well, that's a lot different than raising millions, betting it all or nothing, like your previous venture that didn't make it. So that's why I call them practical founders and not just bootstrappers that don't raise anything. There's a practical place for practical funders and help that gets you started. How much did you raise totally?
I like that you call it a practical. We were trying to be that, so we raised 250 grand at an $800,000 valuation when we got started.
Yeah,
And
yeah,
if you think about Shark Tank, they would have laughed me out of the room. I had no
yeah,
revenue. I didn't
yeah.
have finished product yet, but Corey was practical and understood that I couldn't just get started without some upfront revenue because
Yeah.
I needed to quit my job and I needed to be in a position where I could wait from November when I sold people on the software until the following September when professors would send their students to my platform to pay to use it, right? So
Yeah.
I needed bridge money, basically. More than I needed to give up equity, I needed like bridge loans. That would have been ideal. If I could have found investors that were willing to just pay me, to give me bridge money where I could pay back faster and then hold more equity, I probably would have done that. But one of the things that my CFO told me was, Stu, the nice thing about an $800,000 valuation, as much as it stinks to give up equity, is that now if you only sell it for $3 or $4 million later,
Yeah.
everyone still wins. You'll be happy, the
Yeah.
investors will be happy, everyone will have won. And if you take a $10 million valuation, then those investors aren't going to be happy unless you're able to sell
At
for
a $50 million
$50
post money,
million.
right?
Right.
Yeah, then you have to sell it for hundreds of millions, and almost no companies sell for hundreds of millions out
Yeah,
there.
and so that resonated with me. I liked the idea of short goalposts because for me, Greg, taking that $25,000 check, I didn't look at that as like, oh, some small bet. If they won't miss that 25 grand. No, it was like hell or high water. They will get good returns on that 25 grand.
Yeah,
Because for me at the time, especially, 25 grand meant a lot to me, right?
yeah,
50 grand, 100 grand from another. It was like, holy crap, I've got to go eat, live, breathe, sleep this stuff, not just for myself and for my family, for the people that need this software and service I'm going to provide because education totally needed to be changed, but because I wanted to bring returns. And that
yeah.
I didn't realize as a founder how motivating taking money from investors would be for me.
Yeah, if you come at it from the, let's say, the small town mindset, Stu, you're not in the big city and everybody's raising funding and calling you names if you're not going to raise big funding and play the game. with all these people you don't really know and you'll never see again. You had a vision and a need. This is also in the education technology business here in the States. It's very cyclical. People buy the schools and districts buy in the fall, and you have to bridge yourself. So the ed tech winter of cash flow happens there. But you did it with, let's say, a small town, very practical view, saying, I could build this. I don't know how big it's going to get. If somebody's going to invest, I'm going to give them a win. And you were very serious about that, which is like the modern serious way to do it. So you were a practical founder before it was cool.
I guess so. You've made it cool,
Yeah.
Greg. I appreciate you doing it.
I don't know. I at least put a name on it. So
Well,
it's been there.
entrepreneurs, they read Entrepreneur Magazine, and it doesn't talk about this very often, right? This is
Yeah.
not the sexy side of the stories, but
Yeah.
it's so sexy for most founders that they don't realize they have this route. So it's cool to talk about it.
Yeah. Well, when you grew the company and you sold a majority of it. Does that mean you sold almost all of it and you still own some stock in it, or it was a majority? But so was it just over half, or was it
Yeah,
closer
so
to most?
I had given up some equity already, right, to
Right. Yeah.
co-founding team, not co-founding team members, but early team members that got some
Yeah.
equity. The people like friends and family that had bought in the early investing rounds. By the way, there were 3 rounds. The total raised was just shy of 850 grand, I believe. And then with
Oh my gosh! And 3 routes. That's massive.
3 small
You know.
rounds of like 250.
Yeah.
Basically, it was just bridge money to get to the next fall
Yeah.
because that's when we made our money. But the reason maybe I'm losing my train of thought here, but the reason I bring that up is because, well, I lost my train of thought, and I guess that's what some entrepreneurs do sometimes.
Well, it must feel amazing. I've been through this a few times where, yes, you pay back investors and, they played the risk game, but some, family and friends and employees didn't play the same risk profile. They don't have throw it away money. And to show up with $1 million check for somebody who's made a bet on you when you just had an idea, they believed in you, is actually one of the biggest gifts you could imagine. You could help grow careers of your team members and give these, bonuses. I've seen it where, family members get multi-millions out of, I just wrote you a check and I thought it was going to go away.
Yeah, that's where I was going. You've jogged my memory enough. The people that took their piece of the pie early, they all got paid out by the private equity group, Tritium.
Yeah.
Then those that had employee stock options, including myself as a common stockholder and preferred shareholder.
Yeah.
We all only sold 60%. So we all rolled the rest of our ownership. In total, what I still own of the business is about 20%. And so I'm very invested in continuing to see Stukent succeed.
Yeah, and that's the now most common exit for practical founders, which is private equity, growth equity. The 2 bites exit, they'll buy a majority of your company, and you still have stock and ownership. You have a vested interest in making sure it grows and succeeded, as Stukent has continued to grow and succeed. And the old days, if you did a partial exit with an earnout, you kind of discounted whatever you were going to get, probably wouldn't show up. But these days, founders of the 2 bites exits are winning even bigger with a smaller percentage on the second bite because the thing grows. So you're aligning with these professional investors. And Jim, the new CEO, has a vested interest in making your thing pay off and eventually sell someday to the next investor. That's the game.
That's right. So the amount I sold was life-changing amount. I never need to work again if I don't want to. Saved well that way. But Jim can come in now. Before I even stepped down as CEO, it's been 3 years now since the deal. I just recently stepped down, and it already has more than doubled since that. And so it's going to keep going and growing. There's a bright
Stukent business, not your asset in the
no, my own personal ownership and other things. Well, you could start to calculate what that looks like. I don't even know for sure where that's at today, but it's grown as well. But the fact is, the Stukent investment, the ownership I still have in Stukent is still by far and away my best investment.
I love that. Well done. And you're probably a practical guy without a lavish lifestyle as you were growing this thing as a scrappy entrepreneur in Idaho Falls. So maybe you have the big house and ski house up there and the mountain and all that good stuff there. So That's awesome. Congratulations on a journey there. You got a smile on your face. So I know it was not easy, and they're always difficult, and you have these life or death moments and a lot of learning along the way, and some scars and all that good stuff. So congratulations on that. Let's talk about the Stukent journey. You created this software platform with content and the simulation that goes into universities. You were the innovator in the textbook and online game, right? The underdog coming after the big guys here. How did you come up with this idea? What were you doing just before that?
Yeah, the name Stukent is a concatenation of Stu and Kent, but it plays on the word student, so people don't really
Who's
wonder.
Kent?
Kent was my professor that taught me digital marketing,
Ah, there you
gave
go.
me the first taste of it, and then he's also the one that helped me get my first internship. And he came to me and said, "Hey, you've been hiring my students for your digital marketing agency. Will you come and teach digital marketing at the university while I go to BYU Hawaii to teach?" And I was
Mm,
jealous of him getting that opportunity, but excited for the opportunity to teach. And then I was blown away that over the course of 4 years, the content for his course really hadn't changed very much
yeah.
over those 4 years from the time he taught me until he asked me to come back and teach as an adjunct.
And that was digital marketing, which was changing by the month at
Yeah,
this point.
this is from 2007 to 2011.
Yeah,
So
the early days, you would say, where
early
SEO
days,
became important. Yeah, all that.
it was changing so much. The Google algorithm
Mhm.
was evolving really fast during that time. And so as I was teaching the course, I was banging my head against the wall that there needs to be a more current textbook that's digital so it can still embed video, so it can still have links to good content. Someone's got to go keep that current once that's
Mm,
digital. And so that was the original idea I had for it. And when I called over 100 professors from 100 different universities, 60% of universities were teaching it. 40% still weren't teaching digital marketing, and Google Ads had been around and making money for a decade. That's how
yeah.
slow academia moves. And so I saw an opportunity there to go help academia catch up and keep up with the world of digital marketing. Professors loved us for doing that.
And so your first, let's say, insight, having been a digital marketer yourself, I take it, and then teaching this insight and seeing the reality. This is the vertical market game. We go from the real world inside an industry and deep inside and realize it's 10 years behind
Mm-hmm.
reality. Your first insight was current content, not this super simulation, real time simulation.
Yeah. So while we were doing the market research and calling those 100 professors, one of the professors said, I'm not that excited about a better textbook or a more current textbook. To me, what I think would be really cool is if the students could not have to build a real website because they have crap to sell online,
Oh,
or they come up with something to try to sell online. They should add garbage to the internet for a semester and
right,
then throw it away. Like,
right. I see that a lot.
I want to help my students know how to spend money with Google Ads, but I don't have money to give them for Google Ads. And the Google Ads challenge is only once a year, so it doesn't work for the other semester. So I can't use that and be happy with it. And I was like, bingo, if I can solve this guy's problem, what he's talking about, I will have really won. The textbook thing, like he's saying, people go, you don't turn ahead with a textbook. There's other companies that have textbooks. Even if it's more current and you're updating it, you're committed to doing that.
Especially some guy in Idaho
When we
selling
said we
to the
have a
big university. Yeah.
simulation, everyone wanted to talk. Everyone wanted to take a look. And so
Okay.
that allowed us to then sell the textbook. And the textbook outsold the simulation, but it got people's attention. The simulation got the
That's
attention.
interesting. So when you launched and came to market that year after raising a little money and building something and going into the fall season or selling, you had the simulation story in there, which is real world practice.
Yeah, the first version of the simulation was called the Real Deal simulation. And we actually licensed it from engineers out of Romania. Flew out to Romania
Oh,
to make a better deal with them, and they were incredibly unreasonable with us. And
hmm.
so we got with an attorney, hired a new CTO, uh, lived out the life of the contract with them, and then launched our own simulation that was built in a entirely different programming language and that we really dotted our I's and crossed our T's that we weren't going to be in trouble legally with the group that we originally worked with for our first
Right.
simulation.
So in order to, you've found the opportunity, we want simulation, but you didn't have a simulation platform. You licensed technology that you found that could be useful, and you work your way out of that. You grew out of it and built your own platform, and you became the digital marketing simulation education company.
Yeah, Greg. It was crazy to see how quickly things took off. We had a couple things that were key to our success early. BYU Provo, the school, the
Yeah.
head father school of the church
In
education
Utah. Yeah.
system in
Hmm.
Provo, Utah, is the Marriott School of Management. Is a top 20 business school, top
Yeah.
three accounting program, and so
Yep.
very reputable, right? Very well published professors. And so when that university was happy and using it, getting other universities like University of Minnesota, Oregon State were number 2 and 3 on our list was
Hmm.
so much easier. And then once you have 3, getting to the next 5 is much easier because 3 are
Right.
already using it and happy, right? And so we grew that way really well. That was
Can I ask you about that? Because that's really important. How you kind of climbed the credibility ladder or the ratchet, the mountain there. You started with a big school that you had relationships with, sounds like. Was it their referrals that created the next customers, or just if Bob at BYU uses it, it must be good, just their credibility?
the latter. It was just
Yeah, great.
our hustle. We still had to go to the other schools and get their
Hmm.
attention. But what helped get the attention and then keep the attention and then get them to the finish line was the trust that if BYU's using it as happy, then
Yeah.
others should be too. Yeah,
So that's pretty crazy to go into a massive education content textbook market. And was there anybody else showing up with real time simulation technology like that? And you were the scrappy little company, probably just a few people.
we were the scrappy company and the only company that was out there hustling digital marketing. So it wasn't that McGraw Hill, Pearson, Cengage didn't have a digital marketing offering. It's that it was one of thousands of offerings the sales rep had to cover when they
You were
went
the
and showed up.
specialist. Yeah.
Yeah, so we were the company that had the unique, focused efforts around supporting a digital marketing professor. And so people appreciated that and gave us a lot of credit for that and looked at us as the experts for that. By the way, I did have some things in my background that helped. I had been the owner and started getfoundfirst.com, a Google Ads premier partner company. And my
A
co-author,
services business in digital marketing, right?
that's right, a services
Yeah.
business in digital marketing. You can still go check out getfoundfirst.com. I sold it in 2015. They've been on the Inc. 5000 list the last 4 years and are doing way better with it than I ever did. And that's fun to watch when you start something up and see it keep living beyond you. Jeff Larson, my co-author for Digital Marketing Essentials, the first textbook we launched and sold, he is a graduate with his PhD from Wharton, top 3
Mm.
business school, and he is now a professor at BYU, and which is a top 20 business school. And so, getting on stages at the American Marketing Association all of a sudden wasn't very hard for us, and to turn heads and get attention.
Because of him and his credibility. Yeah.
That's right. So my credibility from industry, his credibility from academia was a real win for us and helped get that
Okay.
initial traction.
Was he a co-founder in the Stukent business, or was he just the content contributor for the first textbook?
No, he was not a co-founder. He is one of the highest and best paid in the company's history because of his royalty agreement with me. But he's just an author. Looked at as an author, and it's
Yeah.
been a great win-win for him and
Did you have a co-founder here, or was this
no
Stu
co-founder.
and his friends? Yeah.
Yeah, I was blessed to have started a Christmas light guys business in college where I put up Christmas lights for people. I think a lot of entrepreneurs start with some sort of a service-based business first, easy
Yeah.
to bootstrap. Then I had Get Found First, and in both of those businesses, I had co-founders. And I decided when I do my next one, I'm doing it by myself. I don't want to have to deal with a partner anymore. And I want to do things my way and not worry about whether I'm making them happy or keeping them happy. Like, this will just be my thing.
This week's podcast is sponsored by my friends at Cypress Growth Capital. My favorite milestone for practical SaaS founders is after you've survived the first few crazy years and you have some repeatable sales and a growing team and perhaps a little profit showing up. You know you could grow faster with a little outside capital, but the thought of raising money from VCs would change your whole game. And we know VC funding is the most expensive growth capital on the planet. That's why so many practical SaaS founders I know have partnered with Cypress Growth Capital when they hit that predictable growth inflection point. For 15 years, Cypress has provided non-dilutive growth funding to bootstrapped SaaS founders, including many of the successful founders I've had on this podcast. They love practical founders. Cypress provides enough patient capital for you to invest in your growth without giving up any of your precious equity or having to guarantee a loan personally. Their investment team has people like you who have grown and sold successful software and technology companies, and their operational and entrepreneurial experience helps them give you strategic guidance at those key inflection points in your business. So go to cypressgrowthcapital.com/practical and learn more, and contact Cliff Santel at Cypress to see if there's a fit. Now back to our podcast. And it sounds like in your business model that you have software and simulation software that you sell, and authors, like your first digital marketing textbook, were partners that you sold their books and they sold through your platform. And now there's probably many authors selling content and updating it, keeping it current through your platform now. Is that kind of one of the business model innovations, is you were a platform for innovative authors who were experts?
Yeah. So I think this is one of the areas of entrepreneurship where people don't realize they can innovate, which is around the contracts that they're creating.
Yeah, the business model.
Yeah. So when you sign up professors to be a textbook author, like, that's very common. Pearson McGraw-Hill have been doing that for literally a century, right? And so for Stukent, when we went about our author agreements, we took a very different approach in that we were asking them to do updates annually, no matter what the sales benchmarks looked like. They were going to have to commit to doing that. And if they didn't, there were harsh ramifications for that. And the thing that's cool is we created a culture where our authors wanted that. They were okay with whatever the harsh ramifications were because they wanted to update every year. And our competitors have 3-4 year maybe type of update experience with their contracts. So that's a big key differentiator for us.
So you found some business model angles, technology angles, so forth, that compete against these huge textbook companies.
And then another angle I found that I think, and this is something that I stumbled into and learned along the way that I'd love to share with other founders. Simulations existed already. Textbooks, even digital textbooks, existed already. No one had married them together. And simply marrying those things together was innovative and new. So you've seen this with Topgolf now, right?
Oh my God.
The concept of concessions existed. The concept of a golf driving range existed. Similar to the bowling alley that it also already existed. They just married other innovations that existed in the past, created their own new variation in a different category, and had something new and innovative and different. And I can guarantee you there's no one listening to this podcast that has also been to a Topgolf and didn't think to themselves, why the crap didn't I think of this?
Yeah, that's
and
an
those
entrepreneurial
things
invention,
exist all over the place. It's going to be fun to watch the new innovations that come from things that already existed done a little differently.
Yeah, I call that a purple ocean strategy, Stu. So the red ocean is the crowded market. You don't want to go there. It's commoditized. There's 1,000 competitors. There's no differentiation. You're just going to be fighting it out with everybody else, and it'll not work out. The blue ocean is the new category, the new thing. When Uber started driving pressing a button on your phone to get a car instead of a taxi was not even a concept in our mind. So They went out into the blue ocean and created a new category, created a new thing. And, we didn't do it before, but now we do it. But purple ocean is that combination. It's kind of a mix. It existed. And so people could tell it's this plus this, equals that. And the story gets really quick. Simulation software. Yeah. Textbook. Yeah. Well, boom. Right. And people get it really quick instead of selling it for days and days like a blue ocean. So very powerful, and it's very practical for founders out there. What other innovations did you have to grow? What was in your go-to-market that was creative?
Oh, all sorts of things in the go-to-market. This was one of the areas where I loved to innovate and have fun. We would create these sponsorships with
Mm.
the American Marketing Association for their events. And we would say, hey, when we do the event, if we can do an email in advance to your customer base, we will email them and ask them what's their favorite candy bar. And so they were like, yeah, if you want to try that, it'd be fun. Let's do that. So they started letting us have access to the email database of attendees, and we would send out an email that didn't talk about our products at all. It said, we're looking forward to meeting you at AMA in Florida. Can't wait to see you next week. Take a second and reply with your favorite candy bar, no matter from where it is on the planet. We promise to bring it to you in Florida. If we can't get it to you there in time, we'll ship it to your office. So it was fun for these marketing professors to go, no way, let's see if they pull this one off. And they would come up with these random candy bars that they probably didn't even care for. They just wanted to see if they could stump us. Mm-hmm. And Amazon actually makes it pretty easy to get any candy bar from anyone. And so we would get these candy bars shipped either to the hotel we were going to be at or to our house, and then take them with us. And then the easy ones, we would just stop at Walgreens before we walked to the conference and buy the other candy bars we needed. And people would be like, hey, did you actually get me that Toblerone? And because they're thinking that's like a $4 candy bar. You can't afford to hand that out to everyone or whatever. Yeah, here it is. And so people were intentionally coming to our booth, and the other exhibitors, which by the way, we were in this cool space where there were 10 exhibitors at a conference, which was awesome. We stood out, and everyone was coming to us, and people were looking around like, what's going on? Well, it wasn't our innovations that they really needed as professors. It was the stupid candy bar they wanted. And that worked for a couple of years, and it got old. We brought a 3D printer to another conference and would print off their name and like a nameplate for their office. And it had the Stukent logo on it. So everyone's leaving our conference with a Stukent logo that's going to be on their desk forever. We were a digital company. We didn't drop off a textbook that had the McGraw-Hill logo. But we were in still every professor's office. Those are just a couple examples.
Well, you found a way to differentiate, to do something different and be remarkable, all that stuff, the pinnacle of the marketing game. I thought you might say, well, we were experts at digital marketing, but sounds like I'm sure you did the basics, the blogging and the social and the website and the conversion and so forth, but you got right out to these professors, marketing professors, and, did something really creative and innovative that when you look at it, what's a candy bar for 4,000 people? Okay, maybe that's $5,000 or something like that. But then you got all the professors, right?
That's
to give you their emails and so forth. So, most people wouldn't do that. Is that how you're an entrepreneur? You're just right there thinking of ideas and then finding the very, creative one that gives you leverage?
For sure. I think every founder has their things that they're great at. I really admire the founders that don't have to be the spokesperson, that aren't the face of the business as much as I had. It felt like I needed to be. Like that was my strength, so I better do that. But yeah, for me, I was always thinking about what else can grow this thing. Always focused on growth, growth, growth. What else can we try that will get us more attention?
Not funding to get growth, but just growth. Like what creative growth can I get that will fund itself?
Funding only was there because we were always focused growth, growth, growth. Oh, we're not going to have enough growth to meet the short-term problem of not making money from January to September because we're a school-based
payroll.
Like, we need money. Okay, let's go get it. We have it. And it was so easy to get money. Greg, funding was not hard for Stukent. One, I had trust up front with some friends and family. But two, after that first round, I could go to them and say, hey, because this group gave us money, we've gone and signed up 100 universities for year two. And then when we needed money the third year, we said, after year two was over, oh, look, we're not going to have enough money. Let's go raise some money. We could go back to our original investors, and most of them just re-upped because it was like, hey, we're going from 100 to 300 universities.
Yeah.
Right.
Well, that sounds like the VC, funding shuffle, Series ABC, but you just did it in little 250K chunks.
Because it was.
Did you ever raise debt in there to bridge?
Then finally I got wise, Greg, and I raised debt. I realized I could go to wealthy individuals and say, hey, do you want to earn 10% on your money? We have this short-term need. We can explain how we're going to go and get the money you need to pay you back.
Predictable.
By September. Mm-hmm. It's predictable. You'll earn this much. And if you want, we don't have to pay you off right at the end of when we don't need your money. We can extend longer than that. And people were okay with that. And so instead of the last 200,000 we probably could have raised for equity, we just got debt for it. And looking back, I'm like, that was so stupid. I should have done that after the first 250 grand. I didn't need more equity. More equity.
You could have skipped around with your SaaS debt and not given up, another big chunk of equity. SaaS debt, SaaS funding, revenue-based funding are all forms that are very popular with practical founders who've hit that inflection point where if you put $1 in, you can get $2 out. And you just, you'd bet your house on that as opposed to some other kind of wacky bet about, phantom growth. But
and guys, Greg just pointed something out that I think is really important and overlooked by founders that are raising money. If you can point at, look, we sign up a professor every time we spend about $1,000, and we're going to earn $2,000 off that professor. And then we're 3 years in, and 85 or 90% of those original professors are still back for year three. Now they're going, wait, so I give you 1,000, you bring me back $2,000 year after year. Yeah, I'll do that deal, right? That's doubling their money in year one, and every year after that, it's better than that. So if you can prove the economics of your cost to acquire a customer and the lifetime value of a customer, and then keep proving it through retention over the years, then when you go to do a private equity deal, it's easy. There's so many people that want in on that, on those few businesses.
You've created the magic machine that debt funders want to chase in SaaS, and investors want to chase in SaaS, and acquirers want to chase in SaaS, especially private equity investors, is if I have a predictable growth engine. Yeah, we have this magic technology and we got to manage the company. But if what the magic is I put $1 in customer acquisition and I get 5 out of lifetime value, and it isn't changing. That's the magic of SaaS these days. So
yes, it is.
And and it creates cash flow for founders too, if you know how to do that well enough, and you don't have a seasonal effect in there like you do in ed tech.
Yeah. So ed tech founders, by the way, they're going to see 5 to 7x, 3 to 7x is probably a better range to give you. Whereas a true SaaS monthly recurring revenue business that retains well is going to see 8 to 12, would you say, Greg, on average?
Yeah, 5 to 10 these days on average with upside there. And that's multiples of revenue when you sell your company, the valuation for your company. So you're saying ed tech has a little
discount
negative effect because of that seasonality and having to resell to schools and districts every year. The multiples are a little
as long as you can prove the retention, they'll start treating it more like true SaaS business. There you go. Right?
Great. So you grew this business and you got the flywheel started and you knew how to acquire customers. What challenges did you face getting to 100 employees, which is not a small thing in growing the business in Idaho Falls?
It was all sunshine and rainbows, Greg.
Nice. No, it's like we're on stage at a big conference, Stu. There I was.
Oh yeah. Well, I think one of the biggest challenges of a business that gets to 100 people is for the founder is figuring out which hats to keep wearing and which ones to get
Yeah.
rid of. And the faster you get rid of more, the easier your life gets. So trust people. I would say learning how to trust people and let people fail and be okay when it happens, because overall your life's better for having done it and the business is better for having done it.
Did
Even
you
though
struggle with that?
for me, that was a struggle. In fact, when we brought on some of my executives quit after the exit, I stuck around and
Mm.
I was thinking to myself, I could do this for 20 more years. I really enjoy this. I'm still doing well. I
So
love
you
the
wore 'em
growth.
out.
I love the personal growth challenge
Yeah.
of
As a
uh,
CEO.
I've never done a business at 4 million. Sweet. I want to see what it's like to do it at 6. This thing's growing to 10 million. I want to see what it's going to be like when it's at 20 million. What are my different challenges as a leader? So I love that personal growth that came
Mm.
with that and those stages. But the new executives that came in were like, "You're too into this, man. Like, you hired me to
Chill.
let me run my show here and step aside. I don't need your help." And that was hard, right? Because with my
Mm.
first team of executives that I grew the business with, they were used to me being really engaged and running most ideas by me. And all of a sudden, the new executives were like, "Get out of here, bro. Like,
I've
you're
been
getting
there.
in my way."
Both sides of that. Yeah. And was that, difficult? I mean, what stage did you experience that, bringing in senior folks? And were they in Idaho or were they all over the place? Meaning, now the senior folks said you can't be the CEO of a junior leadership team. You have to be the CEO of a senior leadership team.
Yeah, I was very loyal to my initial a team of
Yeah,
executives. So they stayed
of
the
course.
same all the way through, except at the position of CTO, it was pretty mutual agreement. Like, this has kind of outgrown you,
Yeah,
and
okay.
he's done great things with his career before and after Stukent, but it
Yeah.
wasn't right for him to stay the CTO. He wanted to build more, didn't want to lead as much, and struggled with the leadership side of it. And so we got a new CTO. He fit well pretty quickly. It was an adjustment for him to learn how to work with me and for me to learn how to work with him. But
There
that
you
new
go.
CTO was great for the business and was there at the exit as well. So that was really, we added a chief product officer, added a chief administrative officer, which is more like a kind of operations person.
Yeah, yeah, of course.
Uh, yeah, so I think that the new seniors came mostly, I would say, after the acquisition, and some of the original executives decided to have taken their payday and say, okay, that was far enough with me with Stukent. I want to go do my own things. And it's been fun to watch them, by the way, Greg, go and do their own things. Shout out to Brandon and Trevor. You guys are doing awesome.
Yeah. Awesome. What percentage of your leadership team is still, with the Stukent 3 years after new CEO and the management, approach?
Yeah, it's a good question. Two of them, the chief
Yeah,
administrator,
okay. Yeah.
three of them. I take that back, three. So
Yeah,
the chief
yeah.
product officer, now his title is chief content officer, actually. Uh,
Yeah.
and then our chief financial officer has grown well with the business, and our chief administrative officer has grown very well with the business. So those three are still there. The
Yeah.
marketing officer, revenue officer, and executive officer are no longer part of the team.
Well, for all those founders that are, at 10 employees and they think about 25 and getting some management in there in between the CEO and frontline and so forth, by the time you get to 100, you need to have a senior leadership team. And you don't always have to hire them. I mean, one of the great things is you get these amazing people and you can grow as a CEO and they can grow as a VP and you could
Mm-hmm.
grow people and create careers and you create an opportunity factory for people to grow up if they want to keep growing. It's really one of the gifts that you can give when you grow a bigger company. So
Yeah.
it's an encouragement to not, sell too early is because you can change the world and grow your community and your team along the way. You eventually sold the company and hired Was it Michael Lyon and team over there at Vista Equity, Vista Point Advisors, the M&A advisors to sell your company? Was there an instigating point where you said, all right, it's time, either the market or post COVID or I'm tired, or what was it that made you think about selling your company?
So many things made me decide it was the right timing. 2021, there was COVID. There was concern that with the new administration, tax implications could happen that would
Hmm.
negatively impact my,
Yeah, if you have a big win as a founder, yeah, that could be interesting.
yeah. And so those were things to consider. Also, I had actually talked to the private equity group, or sorry, to the M&A folks. It was
Okay, Jeff. Yeah.
Jeff
Hmm.
Koons and Mike Greco for me that were working with me at Tritium, or sorry, at Vista Point Advisors.
Yeah.
And they talked to me, they did a pro bono analysis of the valuation of our business in 2019 and 2020. And
Mm.
then in 2021 was when it was like, this feels right. They talked about what they were seeing in the market, what companies were getting. By the way, that was like,
Well, and prices were spiking then,
prices were
right? And
high for business. The best valuations I think ever in the history of the world were about that time. And
yeah,
so
yeah.
we did well in regards to the timing of that. But I knew that I needed to get a payday for my investors. That when you're an angel investor and you give 25 grand, that money is just not doing anything for you for, in their case, 7.5
Hmm.
years at that point. No payday, no interest, nothing. And I knew that I was at a place where if they got a payday, it was a mega payday. And
Yeah.
the last thing I wanted was to have something go wrong where it wouldn't be as good of a payday, or they wouldn't get to enjoy the same tax benefits that we did with QSBS, qualified
So
small
even
business.
at
By the way, if you don't
less
know.
than a million of friends and family investment, angel investment, you didn't consider them donations. You considered it a business arrangement. And when you take investors, you're agreeing to sell your company someday to pay them back. You had a very, you had a fiduciary responsibility to
Absolutely, yeah.
respect
For
their
me, I took
investment.
that really personal. Hmm.
Yeah, totally. So, what was the process like generally to shop it around? You got your pitch together, you got your financials together, and the folks at Vista Point Advisors, the M&A advisor, take you on the road, shop you to hundreds of companies, get term sheets. What did it look like for you there? You went and proactively marketed the company for sale.
Yeah, we put together what's called a SIP, CIP,
Hmm.
or CIM sometimes is the
Yeah.
acronym they'll use, but it's an information packet that has there's like a one to 3 page document first that goes out with no signed NDA agreement. It's anonymous as to what the business is, what the name of the business is.
So it's detailed, but about the numbers and the facts, but it's not. It's unidentifiable as a company.
Yeah, and it's high level, right? And then after
Okay.
that goes out, that goes out to thousands of people in the network of buyers that the
People acquired.
investment bank has, and that's a
Yeah.
key value that they bring to the table. By the way, when you hit the Inc. 5000 list one time, for the rest of your life, you're going to keep getting hit up by private equity groups and investors that are going to try to talk you into doing a deal with them,
Yeah.
and they
Uh-huh.
are trying to get you to do a deal without
Before
getting
you, yeah, inflate
exactly.
the price.
Yeah, before you go and find an investment banker who's going to help you shop it to a bunch of buyers. And so it
Yeah.
was amazing when we would get on calls with potential buyers. Everyone knows Jeff Koons and Mike Greco on those calls. They're like, "Oh,
Uh,
Jeff, hey Jim, good to see you
is that
again."
because they're ed tech focused or they're
Tech
just
focused,
yeah.
yeah. So
Okay, there we go.
they knew
Yeah.
the M&A specialist at Pearson, at McGraw Hill, at Cengage,
Yeah.
at all the
They're in
places.
the club.
Yep. Yeah.
Yeah.
So there's a lot of value in that. And then after that initial 3 pager goes out, folks that are interested sign an NDA. About 70 some companies
Oh my goodness.
signed an NDA to learn more. And from there, about 35 or 36 of them gave us a first bid. And the first bids ranged all over the board.
Yeah.
I'm talking tens of millions of dollars of range in valuations that were placed on the business. And so at that point, I've never spoken to any of these potential buyers. I don't know who they are. When they first put in the first bids, I then find out who they are, and it's flattering. And then the investment banker says none of those bids are good enough, and we're going to drop the bottom 80%. They're gone. We're only going to deal with the top 20% now. And
The
then
low
they go back
ballers,
to the
right?
point.
You're not convinced they're going to come back with a better offer if that's where they started, I guess.
That's exactly right. And so then you go to that the investment banker goes back to that 20%, says, hey, thank you for your interest. We're going to do management presentations, but there's so much interest and so many bidders that you got to come up with a second bid. And if your second bid's good enough, then we'll invite you to management presentations.
Mm-hmm.
So from there, we had management presentations with just the top of the line.
How many were in the top semi-qualified?
Yeah, we spent 1 hour with about 12 groups.
Okay.
Just me and the CFO. And then we went back to everyone. Well, I say we, but the investment banker goes back to all of them and says, look, there's a lot of interest. If you're still interested, give us your final and best.
Yeah.
We narrowed it down to the final 3 and met with the final 3 in person.
Mm-hmm.
Or if they only wanted to do virtual because of COVID, we did that. And with those final 3, we determined the top 2 and got serious, spent more time. With the top 2, we actually chose, Greg, the second highest bidder.
Yeah, that's not uncommon.
Because the investment banker said the highest bidder here hasn't been that engaged or involved. So there's a chance they'll back out on you even after they lock you in for a while. Or they'll lower their bid later. Like, you just don't want to do that. And then 2, if you think you like the second group and connect well with them, I think you take the second group. And so we followed their advice, took the second group. Glad we did. Vista Point Advisors was phenomenal to work with, and we've loved the engagement with Tritium Partners as well.
Awesome. Well, that's great. So what advice do you have for founders out there that they've got a number in their head and they're building this business and they're saying someday, maybe I'll grow it for long, maybe I'll sell it. We have the optionality, practical founders. What was the biggest thing that you were glad you did in your business that when you got to selling it and people were putting a fine point on the numbers and, that you were glad about the way you ran the business? Was it retention or your growth rate or the predictability? What was the magic thing that you were so great about? We'll ask you about what you could have fixed in hindsight. But what was so exciting about this business to these investors?
The thing that was most exciting to them was retention and increase in revenue earned. So
per customer.
Yeah. So let's say that we found that if you signed up in 2014, you were still using us in 2021. Not only were you still using us, but you were also spending about 4 times what you were when you first started. And the reason they were spending so much more is because there were more professors for more subjects, and we could continue to create new products to go back to the same audience. And so I would say those 2 things were the big. And then also, probably above those 2 things, a sales and marketing machine. We knew how to go acquire new customers.
And they kept asking questions, and you had the data, and they dig in and ask more questions. You had the data, you had the answer all the way to the bottom, and they're probably like, nobody does that.
The buyers, you're talking about the
of course. Mm-hmm.
The private equity groups for sure. Yeah, they're going, oh my goodness. The CFO did a very good job of proving in the spreadsheets. And that's a key to the success, guys. It's not just about being good at the selling. It's about proving how good you are in the spreadsheets. You have to do a good job of that.
I hear PE buyers like spreadsheets.
Yeah.
What thing would you have liked to have addressed in your business beforehand, Stu, that looking back, you would have emphasized more heading into an M&A type transaction?
Younger, I wish I had in the business. I wish I had realized the power of retention. We were so good at outpacing churn with new sales, and that we didn't worry as much about retention. So I had a salesman early that was like, "Hey, can I switch to being a customer success manager?" And I was like, "No, we are focused
New
on
customers.
growth."
Yeah.
You know.
Yeah.
And looking back, I don't know that I agree. I still don't agree that the right thing was customer success managers. I wish I had invested more and better in the customer experience. I didn't.
Yeah.
I trusted a CTO who said, we're going to have a culture where the developers are the ones that do QA. They do their own QA. That is
Ah.
bullcrap. Never buy into that. Do not let anyone tell you that you don't need checks and balances with your engineering team. You need QA testers, good ones. And I that was a regret because that's where you retain. You can kiss.
Ah.
I always was telling people, look, we can kiss butts to retain people and keep people happy, but the real way that we're going to retain customers is a better customer experience. Not by going
Yeah.
to them and apologizing nicely and telling them we're going to get better
Yeah.
and listen to them. No, let's just go give them a better experience. And I took too long to get to that place where I got serious about that.
Yeah. Great. Well, I'm sure that's in the playbook at Tritium, is, all the dials measuring all of that, and growing revenues through expanding with customers and adding efficiently on the front end with new customers. What did it feel like when the money hit your bank account and you walked out that day and you say, I'm not the, I don't know if it was the same day that you transitioned from being a CEO, but what did it feel like when you sold the company? M&A processes are long and brutal. Uh,
Yeah, you think about
was
it
it
for so
bittersweet
long.
or yeah,
it
yeah,
gets it gets starts to get real in that process, and you're like, oh, it's
mm,
gonna happen. Like this is gonna happen. Once that
yeah,
happens, then I think you have this like sense of a little bit of relief. And then the day that they like have the call with you and they're like, hey, just checking
push the
everything's
button.
right here, okay. And there's this just it's just a phone call, and then the money's wired.
Yep.
It wasn't
Hmm.
a boardroom and signing a bunch of documents. There was a bunch of clicks with
Yeah, yeah,
DocuSign, and not nearly as many clicks or as robust as I would have expected. But you get to the finish line, and then it's anticlimactic, I think, a little bit. For me,
yeah,
there were two celebrations. My CFO and I called each other and
yeah,
screamed as loud as we could on the phone
yeah,
with each other in a fun
yeah,
moment of like, we got there, like we did this.
yeah.
And
Climb
then
the mountain.
yeah, and then with my wife, the who had sacrificed so much for
Oh
so
my goodness.
long
The
to
real angel investor here.
to
Yeah.
stay frugal, right? Yeah, the real angel. She's there. I don't know, maybe cut off on screen, but on the bottom left of screen, you might see Lindsay there. Lindsay was always just so supportive and a cheerleader in dark, cold
Yeah.
days, sad days, hard days. She was always there for me as a sounding board when I needed her and believed and trusted. And so, yeah, that was a huge celebration of my spouse. Beyond
Yeah.
that,
Back to work.
it's back to work. I'm still the CEO. I got to run this thing. I need, now I've
Now
got
you need to hit your numbers.
new
Yeah.
investors that also need returns. I'm going to go deliver for these guys too, right? Like they gave me a big payday. I'm going to make sure they have a win too. And so having
How
taken,
fast was that turn? Did you take a break and take a vacation and come back and warm up to it again? Or was this like Monday morning? It was a new, the sun came up and you were back in the saddle.
yeah, I think for me, I felt this sense of like, well, either I do this and treat this like a job still as the CEO, or this new investor that now owns the majority will find a new CEO who will do that, right?
Yeah.
And so I still had a preschooler at home, Greg, when I did this
Yeah.
deal, and I wasn't 40 yet. So I really needed in my life to still have a career and job and do that. And I found fulfillment in doing that. So I did take a break. I did take some pretty cool, way more expensive vacations than I'd ever taken in my life. Brought the whole family to some really cool resorts, that kind of thing. But it was business as usual and grow Stukent. And after it had done more than double, it was like, okay, I'm not enjoying this as much anymore. The board meetings are hard for me. Prepping for them is
Yeah.
super stressful.
Yeah,
Uh,
it's heavy.
we're growing like crazy, but yet I don't feel that much excitement from the board.
Yeah.
Love you guys, you love me still, but
Yeah, it's
that
funny.
was it's always a challenge to feel like it's never good enough. And
Yep.
so I was like, okay, I don't enjoy this as much anymore. I connected better with the first executive team I worked with. I'm going to let someone else take this thing. I know it can grow
How
without
long did
me.
that take after your transaction that you kind of mentally, said, all right, the second shoe to drop here,
I had
I
get,
need to get a bring a CEO.
After the second board meeting, I was like, crap, this is harder than I thought. This is way
Oh.
harder than I thought. Right? Like those
Well,
are
a little
not.
warning to everybody. Yeah. Uh-huh.
And then
It's intense.
I was like, I love this. I love that I'm growing and figuring this out. I'm going to go figure this out and get good at this. And so I did that for another 6 board meetings. And after 8 board meetings in total, so 2 years, I find myself going, I still don't enjoy this. I feel like I'm better at it. I don't enjoy it. And what the extra value I get out of continuing to work is just the salary of the job. Like
Yeah. Yeah.
that is it. And so I keep the ownership I have. Someone else is going to come in here. I gave up maybe a little bit of
Yeah.
equity in
Your slice.
my slice of the prorated amount of equity given up to the new CEO, but he's doing great. He deserves that. He's doing that work and taking that
Yeah.
stress. And I get to sit back in my chair at the board meeting, listen in, share my advice and opinions, and come back in 4 months, or 3 months. So yeah.
So you're kind of your API to your former business, which you were connected to every person and everything and every customer in the business at one point. Now you just work through the board and the CEO, and you're not showing up in the office and stirring things up and all of that. You're offering advice and perspective, and they may or may not take it.
Yeah, they don't
Yeah,
always take it. Sometimes we disagree, and that's okay. That's a part of the
yeah,
genius of a board is there's checks and balances on different ideas and the
yeah.
opinions, and the best ones win. So
Wow. Well, there's a lot going on there. Did you have a big prize outside of that vacation? Do you own a big ski house on the lake up in the hills there?
yeah,
Or
I think it's fun to talk about the paydays. I own a real estate investment in 42 acres that I think is prime. It's going to be awesome dirt.
oh, you're investing, not riding horses.
I do ride horses. I took my dad on for his 70th birthday. I just came back from a bear hunt of all things.
Oh my gosh.
I think hunting is conservation, so don't get mad if you disagree with me there on that. But I spent time in the mountains. I went to the boat dealer. This was probably the biggest, funnest splurge for me. Was I went to the boat dealer and I said, this boat on this page of this website, I want one just like that with every bell and whistle that you can add to it. And that's what I want. And that was really fun to drive that boat home and to have shared the memories we've made with families, priceless. So glad I made that investment. I'm still a little more like I have a frugal side to me that I didn't buy the
I'm
biggest
sure.
boat out
Yeah.
there. But yeah, I'm really happy with the boat that I did get. Love it. And so, yeah.
Well, that's really exciting. So looking back here, you had and you were a crazy, innovator, instigator, business builder that, you create a few businesses and got into the software and built up Stukent and sold it and won a prize. And, you still have some investment in that business and equity in that business. Stu, what advice do you have most often for software founders who are doing it creatively and innovators and, they're practicals. They may have bootstrapped it all themselves or, raised just a little bit of money. What advice do you have for them about this journey looking back? Was it what
Get
you expected? Was it worth the sacrifice in the
Oh,
scars?
so worth it. Keep going. Keep going. It's worth
Yeah.
it. Don't stop. You're gonna have so many barriers along the way. Break through them, find a way around them, jump over them, dig a hole under them, find a way. I share a lot of advice on my new podcast, Greg.
Oh, let's talk about that.
Yeah,
Yeah.
Startups with Stu is my new podcast. it's a way for me to scale my lunches and breakfast I used to do every time someone asked me,
Yes.
how,
Welcome to my club. Here we go. That's
yeah,
what we're
you know
doing.
all about that. People are like, hey, can we get together? And I do that sometimes and I appreciate that for the right people at the right times. But Startups with Stu is my way to
Thanks.
give perspectives on all sorts of different types of businesses. I have a guy on my show who has failed 4 different businesses. One of them got to over $1 million in sales, and he's one of my best episodes. I have another episode with
Amazing.
CEO of Flashlight Learning, grew it. It's been awesome. So
Yeah.
all sorts of different types of entrepreneurs. If you want to learn more there, you can.
Well, that's our buddy Justin Hewitt, who got us
Yes.
connected there
Yeah.
as well. Another ed tech fast grower and a great entrepreneur himself. What advice do you have for practical founders in the journey about raising money or growing fast or hiring people that would be most useful to them as they're getting on the field and growing up?
Get good advice. Good advice. So you might
Mm.
have an attorney that is a family friend, and most of what he does is civil law. Okay, he is not your guy. Do not take his advice. Go get startup legal advice from someone who specializes in helping startups. You might have to go to a different state for that. Find good startup legal advice. The same goes for your finances. Get a good CFO that understands the different ways to finance a startup. My CFO did that pretty dang well. Love Mike Andrus. He's the man. I wish he had said, hey, Stu, let's look at more debt versus equity right now.
Yeah.
But that was something that he may have missed, or maybe he knew better and
It
it
wasn't
was.
very common a few years ago, like even just a few years ago.
Yeah. So look at it. Make sure you have a good CFO. For me, those were 2 areas, legal and finance, where it was not my strength. I didn't need the best in class, best ever CMO. Trevor was phenomenal as my CFO. Loved the guy to death. We're like best brothers, not best friends. And same goes for my chief revenue officer. And Brandon would have outsold me 2 to 1. He was phenomenal. Having those team members at the top that can build culture with you is really critical. That buy into the culture you want, because they have to spread it to their teams. So yeah, that's my advice.
Great. Well, I appreciate that. Where can people find your Startup with Stu podcast? STU.
Search it up. Startups with Stu will be found on any of the major podcasting platforms, or you can.
Awesome.
I invested in a podcasting platform called podup.com. You can go to startupswithstu.podup.com and find my website there.
Are you an active investor now? That's very common for practical founders who, have a lot of conversations with a lot of great entrepreneurs.
Yeah, part of the reason to do my podcast is to have good deal flow and find good
There you go.
startups to invest in. So I'm an angel investor. I've invested in 8 different startups and plan to do more.
Okay, awesome. Well, I really appreciate you sharing your startup and growth and your change story from founder to CEO to former CEO
Mm-hmm.
and now active investor and podcaster. Thanks for sharing your practical founders story on the podcast, Stu.
Thank you so much for having me and for spreading the good message of being a practical founder. You don't have to go VC, and you don't have to raise money at all sometimes. So, Greg, thank you for being there for all of us founders.
I appreciate it. Thanks, Stu.
Take care.
Thanks for watching this week's founder interview on the Practical Founders podcast. Be sure to hit like and then subscribe to my Practical Founders YouTube channel to keep up with my weekly videos for serious software founders who are building valuable companies without big funding. Check out my blog and information about my Practical Founders CEO peer groups at practicalfounders.com. And follow me on LinkedIn to keep the conversation going. See you next week.